Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Thursday, January the 22nd, 2026. I guess by now everyone understands that Trump did a bit of a taco yesterday and essentially de-escalated sort of political tensions somewhat. Apparently, there's some kind of framework deal for increased American autonomy, maybe some kind of sort of Guantanamo Bay type sovereignty for American military bases in Greenland, some basis for sort of negotiations. We'll see. I don't think that's completely gone away because remember that Trump yesterday, some of the discussions he had, the talks he had, the so-called framework agreement was with the Secretary of NATO, who is from Holland. And so there's nothing yet really with the people of Greenland or Denmark or even the European Union formally agreed. And as is Trump's sort of typical stance, he's going to leave the details of the negotiation to sort of Marco Rubio and JD Vance and others. So I don't think that situation has entirely disappeared. But at least yesterday in his speech, he did sort of take off the table seemingly military action, and also possibly more important for markets, the threat of tariffs on Europe, 10 or 25% were taken away. So we got a bit of a relief rally, and you can see here that we'll get in a second, but obviously the stocks rallied. We had gold having a little bit of a sell-off, silver having a little bit of a sell-off. We saw that the risk premium was basically taken out of some of the markets, and you can see here, for example, the euro versus the USD. The euro came down a little bit versus the USD, and just in terms of risk, you can see, for example, euro Swiss franc. You see that euro rallied yesterday, the green candle against the Swiss franc. But already some of those moves are starting to kind of come back off. The second thing yesterday is that we had from the Supreme Court, there was oral arguments heard about the removal or the potential for the US administration to remove for cause sort of unilaterally members of the Federal Reserve. And basically, it's still quite early, but it seems as though, and again, we're speaking specifically about the case of Lisa Cook, Fed governor, who Trump has tried to fire, a few months ago. And the initial reaction and commentary and sort of interpretation from the justices and their questioning is even from conservatives like Brett Kavanaugh, is that they would it's not going to be as simple for the US administration now and going into the future just to remove who they don't like because of without presenting very solid sort of evidence of sort of criminal or fraudulent activity. And it seems that in the case of Lisa Cook, that was not satisfied. Long story short, it seems as though the judges at the Supreme Court are leaning towards not making it easy for the US administration to fire people at the Fed. What does that mean for markets? That means that specifically Lisa Cook will probably remain for many years on the board of governors. Secondly, it means overall that's a sort of small victory, it seems, for Fed independence. So what can we take away from that? We can take away from that the Fed board, is going to have more confidence that they can voice independent views, and that at the margin probably means that the probabilities of having a series of Trump puppets, a majority of Trump puppets, are very dovish on the board of governors at the Fed is diminished this morning. So that at the margin is slightly, I'm not going to say sort of hawkish, but it means less egregiously sort of dovish than had the Supreme Court gone against that. I mean, there's more twists and turns in that particular case, but that seems to be the general readout. So what we're starting to get overall, I'd say, is this idea that even the US administration, specifically people like Treasury Secretary Bessent, I think is starting to understand that it's not going to be as simple as, firing a few people at the Fed, putting in a puppet or two, and, cutting interest rates by 100 or 200 basis points in an economy which is relatively strong, still with some evidence of sticky at least service inflation. And so therefore, ultimately, this whole idea that, the Fed is going to be cutting interest rates down to 1% over the next, 3, 4, 5 months when the new Fed chair comes in for the first meeting in June is a lower probability. So that's where we're at. So in terms of the dollar, that I think is broadly, at the margin, it's not a bad thing for the dollar as well. And I think, it's going to lead to, the curve remaining where it is just for the moment. Okay. In terms of other stuff happening today, we do start. So the point is that now that, this drama with sort of Lisa Cook seems to be dissipating, the drama with Greenland seems to be dissipating. Maybe the market might get back to macro and sort of economic fundamentals and sort of earnings. Of course, we have the earnings coming up today, more earnings coming up today as well. Just in terms of the data today, we do have core PCE for November you can see here the core PCE index for November, 0.2 month over month. But again, this is quite old data at this point. Consensus 0.2. It's from November, getting even some October stuff from the government shutdown. So I don't think it's going to be particularly market moving. But if it is at that low level of 0.2 month over month, between about 2.4% annualized, a bit more than 2.4% annualized, at the end of the day, that will be feeding into this narrative that inflation is okay. It's still a little sticky, but it's not accelerating in a particularly nasty way. We also get personal income and spending, but again, this is back from October and November, so I'm not sure how market moving it will be. What could be get the market's attention is the initial jobless claims. You see here, that's actually for this week, so for January the 17th, last week. So that is timely data and up to date. And we saw last week that was very low, sub 200,000. We got 198,000, which is indicating, it's a strong labor market. So this idea that the labor market is collapsing is simply not true. We know that net immigration is essentially zero or maybe even negative at this point. And therefore, the idea is that the replacement rate, the so-called replacement rate for new jobs every month in the old days, going back 5, 10, 15 years, that number was often considered, 120, 150,000 new jobs needed to be generated every month just to keep the US labor market stable because of the influx of available workers the pool of available workers was increasing. But if you have a situation of negative population growth or worker growth and negative immigration, or at least no net positive immigration, that means some people, the research I'm reading is saying that, in order to keep the unemployment rate stable, the US economy just has to produce 10, 20, 30,000 new jobs per month. So that's interesting perspective of all of this. So let's keep a lookout for initial jobless claims today. As I say, that's expected, a very strong number, about 195,000 or so. Continuing claims still below 2 million, about 1.85 million. So that's looking quite strong. We'll see how the market reacts if that number's significantly different to that. Other things to look at. Let's look at a few markets relatively quickly here. What is interesting is I want to look at some of the Antipodean currencies, so the Aussie and the New Zealand. And if you look at, for example, the Australian dollar here, you can see very, very strong breakout. I'll just take this back a little bit. Now, if you look at the measured move here, you can see here that this is on a clear, beautiful measured move here on the Fibonacci extension. You see we had a nice run up after Liberation Day in the Aussie versus the US dollar, a bit of a sort of a flagging formation, then boom, breaking above this downtrend. Paused a little bit at the overhead resistance. So trading very, very technically, a little sort of pause at the overhead resistance and now breaking out. Now, where's this going? Breaking out to, I'm not going to say new highs, but new local highs. And if you look at this Fibonacci extension here, you've got to say that the next target for that is potentially a little bit more towards the upside, maybe around about 69, 69 and a half. Now, why is that? One of the reasons, which I'll tell you after my sip of tea, is that basically Australia and New Zealand as well are sort of fairly isolated from some of these geopolitical angst over in Europe and North America and whatnot, and essentially they're benefiting from the run up in commodities and also geopolitical isolation or a stable also a stable fiscal situation. They're not sort of like a Japan or the US or the UK or Europe where there's just too much sort of a debt being issued. So the fiscal situation is stable and also benefiting probably from the commodity run up as well. So all of this stuff is fairly positive for Australia and New Zealand. And just specifically last night we had employment data coming out of Australia. That was higher than or better than expected, plus 65,000 jobs, which was higher than the forecast, were created, mainly full-time jobs. So that's a positive. Unemployment rate fell to 4.1%. So the employment situation, strong data last night for the Australian economy. So the other thing here is that what's that doing? That's pushing up sort of expectations for a hike. So pricing for the hike, and the latest stuff I've saw just this morning was that now for February, 15 basis points, so over a half hike priced in. And for June, we have about 34 basis points of hiking priced in. So we have 15 and 34 for February and June successfully. So a half a hike priced in for February and over 1.5 hikes now priced in by June. Is that getting a little bit overheated because we still have, sort of inflation? We'll have to see the inflation numbers. So the point is that the Aussie dollar has broken out significantly, but keep in mind, just as a caveat before we all go out and sort of, buy more, is that, we have overhead resistance at about 69 cents here. And also, as I say, the sort of pricing for a hike is relatively hawkish in terms of the Reserve Bank of Australia. Now, if we actually look at the New Zealand dollar, similar kind of situation here, not as strong as the Aussie, but um, a strong performance here. It pulled back, now sort of pushing much higher. Again, what's the target there? Is this some kind of head and shoulder, inverse head and shoulder? So you can see here sort of a shoulder head, sort of a shoulder. This maybe has a bit more room to run, maybe up to about 59, or let's call it 60 cents. And again, similar situation to Australia. A stable fiscal situation with a conservative government, isolated from geopolitics, and the economy seems to be turning. It went through a rough patch for a year or two, but it seems to be turning a little bit. We're going to get a read of the fourth quarter CPI tonight, so it's going to be interesting. That's expected to be 3% year over year. And keep in mind, that's a little higher than the Reserve Bank of New Zealand's target range, of course. So 3% is getting too high, too sticky for the New Zealanders here. So that should be a positive. If that comes in a little bit too high. So, but again, the US dollar potentially is going to stabilize. So if you're talking about the New Zealand dollar and the Australian dollar, you may want to look at, some of these cross pairs. So you look at something like the Aussie versus CAD, very strong. Aussie coming back a little bit against the safe haven Swiss franc, but then again, also the Aussie against the euro breaking out, and the Australian dollar versus the British pound, also all doing very well. So maybe the best way to be playing that is a little bit on the cross pairs. As I say, we'll just have a quick look here at the New Zealand cross pairs. You can see here the versus the CAD. Quite strong, and that's something to be looking out for there. So keep an eye on some of those Antipodean currencies. Other things we want to be looking at here. Let's just go back to some of the other markets here. I want to have a look at the precious metals. So metals obviously still very, very strong. Now gold had a little bit of a pullback yesterday, but keep in mind here that that's the pullback happened on gold, but look at that, immediately bought. So there's still a strong, very strong retail demand for gold and silver, which is a bit cheaper, so to speak, in India, in China, and in places like Turkey. So there's still a lot of sort of global demand for gold. And keep in mind that a lot of this gold run up and the silver run-up hasn't actually been in US-based ETFs or even European-based ETFs. A lot of the demand is actually physical purchases by retail clients. So normal people in countries like China, Turkey, Iran, India. And that's still going on, apparently, to the research I'm kind of reading. So we see here the gold did sell off, of course, but actually at the end of the day, there's no technical damage done to this chart, and it's still positive. And let's keep in mind that Trump's speech yesterday, although he took the possibility of military action in the short term off the table against Greenland, the reality is this was a very aggressive speech. A lot of criticisms of Europe, other nations, peoples, economic policies, and very much an America first sort of aggressive tone. So the point is that geopolitical risk may have toned down a little bit in the last 24 hours, but there's still a lot of hotspots around the world. Ukraine, China, Taiwan, Iran is still not completely settled. And as I say, we have a US administration which is keeping the rhetoric very, very heated. And that is supportive for precious metals, is my point. So if we then now have a look at silver here, you can see that silver also selling off yesterday, but similar to gold, it's already kind of pushing back. It's pushing higher. So there's definitely sort of dip buyers coming in here. Maybe one way to look at that, just to keep an eye on things, is as I pointed out yesterday, just keep an eye on this gold silver ratio. The further, if that can sort of push up a little bit, that's going to maybe dampen appetite for silver. So keep a little bit of an eye out for that. Just quickly on the metals, we can see copper. Again, copper is interesting one. You see here the difference between copper and silver and gold, the precious. So you can see that copper here, I mean, it's still okay. I was saying yesterday that it had done nothing wrong, but the reality is that in the last 24 hours, it actually now has slipped below this fib level, which is around about 5.75. Now it's a very critical sort of recent low here at 5.697. Copper needs to hold that and get back into those fib zones, because it has breached not only the 61.8 fib zone, but even a slightly, a larger pocket here at the 65%. So copper here indicating still some risk off, and a lack of confidence in the global situation in terms of trade and whatnot. What is an interesting market as well is the energy markets. So I just want to show just a couple of maps, which I normally don't do, but just important to keep in mind that if we look at nat gas here, well, let's just look at the weather. You can see over the continental United States here, North America, very, very cold weather. All of these sort of purples and lilacs and deep, deep blues here are not good for those of us who live in continental North America. You can see here that it's very cold, and so what that's doing is obviously causing nat gas prices to go up, but also a bit of a short squeeze because the market, I was looking at the commitment of traders, market was very, very short. So people being caught offside and having to buy to close their positions. Similar situation over in Europe. You see that Europe is also very cold. I mean, not as freezing as North America, but still a bit of a cold snap. So what that's doing is putting upward pressure. I mean, it's come off a little bit today with the TTF, but basically, nat gas prices sort of globally are going up. And if you look at the States, I mean, this is a pretty crazy move here. These are massive, massive moves. So we've had, over the weekend, it gapped higher. And since then, we've just had a massive move up. Again, coming up to overhead resistance at about the 5.5 level there on the front contract for nat gas. But let's see, can it go higher? I guess, maybe, because these are relatively illiquid or thin markets. And so, can they push a little bit higher and overextend? Absolutely. Now, what's also happening with very cold weather is that not only for nat gas, I'm going to put up the oil chart here, which has been doing okay. It's come off a little bit. Oh, that's interesting. It's come off a little bit, but it had been doing quite well in the last couple of days. And part of that, just keep in mind, in terms of some of the distillates and products like diesel and heating fuel, generally with the cold weather, things like there's a huge demand for heating fuel and diesel. So the distillates doing better. So possibly what's happening here is that the crude oil not doing quite as well this morning, but the distillates and the heating oil are doing much better on the back of this colder weather. That's interesting there because this chart was looking quite positive. I thought that might break higher. The fact that it hasn't, even with the cold weather, is a little bit of a warning flag here. So that's something I'll be monitoring today, because you see here that's stalling out at the 200-day EMAs. Maybe that's now twice that crude oil hasn't been able to go above that. So that's an interesting one there. Looks as though maybe it just wants to consolidate for a little bit. Finally, I just want to have a quick look at the equities. Obviously, we had that risk on relief rally yesterday. It looks this morning as though the equities are still up a little bit. And again, pushing, bounced off this 50% fib in the ES, which was the 100-day EMA, a relief rally. The earnings seem to be relatively good. We have Procter and Gamble out this morning. At this point, this is still, not a huge amount of technical damage. As I say, a slightly deeper pullback than we've been getting in the last 3 or 4 weeks. But you can see here, if we put an anchoring point on the 21st of November, it did hold the 50% fib zone at about 68.21. Which was, just above the EMA, the 100 EMA. Similar kind of situation here for Nasdaq, holding that sort of fib zone. It's going to be interesting here because there's still a bit of overhead resistance. It's not out of the woods yet, but looking quite good. Russell is the outperformer. So again, this whole idea of the rotation trade, look at the Russell, very, very strong, much stronger than the ES or the Nasdaq. And you can see here that the Mag 7s still, fairly heavy, even though a bit of a rally yesterday, the Mag 7s are still heavy. And if we look at the equal weight, still doing very, very well. So it looks as though this rotation is definitely sort of happening, as people like to say, under the hood, and that the large tech stocks are not doing as well as the equal weights. And if we just have a quick look here, I just might put it onto the semiconductors, SMH, which, as you can see, is doing quite well. So it seems as though it's like really equal weights, small caps, semiconductors continue to do well, and the rotation, the flows are coming out of some of these huge tech companies just at the moment. So that seems to be what's happening. Okay, guys, I'm going to leave it there. Have a great trading day. As I say, we have initial jobless claims at 8:30. Let's see if there are any tweets or geopolitical news coming from you know who. See you tomorrow for the macro snapshot. Thanks very much.